Greetings from Tokyo, Japan. On behalf of Human AI, I'm Steve Monahan, and I'd like to introduce you to what I believe to be the most vitally important topic for any business or government leader: capital efficiency.
Capital efficiency is the beating heart of personal finance, corporate finance, and economic performance. As Einstein so eloquently expressed, compound interest is the eighth wonder of the world. He who understands it earns it. He who doesn't pays it. Considering the wise words of Einstein, why do the most vulnerable in society extend credit to the most powerful? Every day, employees go to work, deliver their value, and in the evenings go home, usually empty-handed. Many wait for up to 30 days to be paid. With families to feed and bills to pay, many turn to high-cost debt. While this may seem counterintuitive, it is a harsh reality for the majority of employees around the world. They are effectively forced to sacrifice their cash flow for the company. The same holds true for small and medium enterprises extending credit to large companies and governments. From an economic standpoint, low-cost debt is being displaced with high-cost debt, simple capital destruction. This inflates costs and suppresses demand, trapping many in an endless cycle of debt. Why this occurs goes back to ancient history. 5 millennia ago, in ancient Babylonia, cattle traders would come to market. They would sell their cattle and then return home. During the next lunar cycle, they would go back to settle financially. What they would observe is that the number of cattle had increased, calves. The ancient Sumerian word for calf was mash. Mash became the word for interest. And from this time, embedded credit has been the foundation of trade and employment. Adhering to this ancient convention makes no sense in a real-time world. Today, I challenge you to get curious about capital efficiency, to explore how you can apply the principles of capital efficiency to make your company more profitable and competitive. To improve profitability and growth, you don't need to be a finance person. You just need to be curious and acquire knowledge. Capital efficiency is the responsibility of every leader who produces value for their company or country. Whether you're in leadership, logistics, supply chain, operations, finance, product or marketing, or any function in business or economic policy that creates value, you should actively optimize capital efficiency. My career journey has taken me from agriculture to aviation into technology, banking, insurance, and investment. Universal principles apply. If you sum up my entire career, I've been this guy. I built the innovation groups at DBS Bank and AIA Insurance. I've always been curious. I have been fortunate to work with brilliant colleagues from whom I've learned the elements that combine to drive capital efficiency. Do you know why technology economics makes addressing capital efficiency a significantly more urgent priority today? Very simply, the answer lies in the velocity of technology and its impact on money. In 1975, Steve Sassoon from Kodak invented the world's first digital camera, producing 0.01 megapixels. In the year 2020, Samsung released a phone camera producing 108 megapixels. Considering this pixel increase over the elapsed 45 years, there has been feature appreciation of 23% per annum. Why that's important is that consumer expectations are for technology products to be better, faster, and cheaper every year. You don't buy a 5-year-old phone because it's obsolete. Feature appreciation plays a very important part in the velocity economics of every business. If you look at the cost side of that equation from a depreciation standpoint, the Altair 8800 in 1975 had 1 kilobyte of memory, representing a 1 megabyte cost of $11,378. In 2020, 4 terabytes cost $748. That is a straight line depreciation of 33% per annum over 45 years. The takeaway is that technology is like sushi. Consume it fast or fresh, or don't eat it. This is why the Agile development maxim stipulates if you don't deliver in 90 days, it's waste. The same dynamics apply to money. Time is money. Time is risk. Time and risk are the foundations of finance. Technology arbitrage is time. Return on capital equals growth of value over time. Technology doesn't do things that we as humans can't do. It just does it more time efficiently. If we can use technology to arbitrage time, we can generate superior economic returns. Simply, less is more. These same dynamics are at play within our financial system. If you think of appreciation, that's savings or investment. If you think of depreciation, that's debt. These companies financially arbitrage time to create significant competitive advantage. They understand that capital efficiency is as important as operating efficiency and product. Companies with great products and operating efficiency, but poor capital efficiency are vulnerable regardless of size. This is now critical in every industry because every company is transforming into a tech company. Technology is an increasing cost in medicine, finance, the environment, society, and manufacturing. In the auto industry, technology as a percentage of the cost of a car is forecast to rise from 18 to 45%. The velocity of technology demands an increase in the velocity of money. Capital efficiency accelerates growth, return on capital, and investor returns. How do you transform? I began my career in aviation, building financial models, flying at night as a pilot, and automating the business as an operations manager during the day. I've been fortunate to have participated in two significant capital efficiency transformations and influenced efficiency transformation at a number of other leading international corporations and institutions. I'm not a CFO. I'm not commercially trained as a finance person. What I would learn was that anyone who is curious can learn what is necessary to drive change. My first scaled experience in capital efficiency transformation was in 1995 with Dell Computer, where I had the opportunity to learn from one of the best global CFOs. In 1995, Dell was emerging from near bankruptcy, as I was told by other early employees. Many had given up their holidays to ensure the company remained solvent. I joined Dell in Asia and headed up product and pricing for the desktop business. Desktops represented about 95% of Dell's business at the time. Compaq was the giant. Dell was the minnow. Compaq was 3 times the size of Dell. Dell's global CFO, Tom Meredith, gifted me my greatest business lesson. Tom focused Dell on 3 things: profitability, liquidity, and growth, manifesting in the cash conversion cycle. I had no idea what liquidity or cash conversion was at the time, but I became incredibly curious. It affected how I priced products for Dell. So, what is a cash conversion cycle? A cash conversion cycle measures how efficiently companies transform cost into cash. Simply, companies transform materials into products that they sell to customers. Supplier credit generates cash. Inventory and receivables consume the company's cash. The net cash is set as a ratio over revenue and multiplied by 365. This shows the number of days it takes a company to transform cost into cash. If you look at 1996, Dell had a worse cash conversion cycle than Compaq. Dell required 47 revenue days of cash to operate. By 2000, Tom had transformed the company to a negative 20-day cash conversion cycle, transforming funding costs into capital returns. This shows capital efficiency is more correlated to management action than business model. Dell's business model didn't change. Dell's management discipline did. Tom weaponized capital against Compaq. The impact of this transformation was significant. By displacing cost with returns, Dell grew more cost effectively than Compaq. Every dollar of growth generated Dell 5 cents of capital to invest, while every dollar of growth demanded Compaq find an additional 13 cents of funding. Simply, Dell was generating returns on capital while Compaq was generating cost. Through the arbitrage of time, Dell reduced the operating capital required to run the business and generated 4x higher returns on invested capital than Compaq. High growth and high ROIC enabled Dell to enjoy a higher market cap than Compaq despite being smaller. The velocity of money matters. If Compaq's CFO had done what Tom Meredith did, it could have increased Compaq's market cap by $54 billion and changed its fate. In 1997, in the middle of Dell's capital efficiency transformation, I joined Compaq. I tried to communicate why Dell was beating Compaq, but failed to persuade global leadership. Fortunately, I was given the opportunity to prove it directly. I led the Asia Pacific Product Marketing Group for a brilliant leader, Sean Burke, who headed Compaq's consumer division. We had a rapidly escalating problem in India. Compaq was number 4 in India, unprofitable and terrible cash flow. Sean asked me to fly to India to fix or close the business. Once I was booked to fly, he graciously advised closing wasn't an option. We all have bosses like Sean. I flew over to India to discover the root cause. The Indian leadership team, in no uncertain terms, advised me it was impossible to compete with the local computer manufacturers. This struck me as illogical. Compaq, the world's largest computer company, had better products, economies of scale, and the greatest purchasing power. I went into the market to observe and assemble the puzzle pieces to complete the picture. I came to the conclusion it wasn't impossible, just improbable. My first discovery was that we misjudged the competition. The competition wasn't Wipro or other major manufacturers. It was worse. The real competition in the market was the white box manufacturers, the no-name PC. Our gap to market was wider than we thought. I returned to headquarters in Bangalore and spent time with the management team, finance, operations, supply chain, procurement, and product. With the learning from Tom Meredith reverberating in my brain, I began remodeling the business in a spreadsheet to optimize operating and capital efficiency. I jumped on a plane and returned to Singapore to solve the next puzzle: product. With support from Sean and the hardware and software engineering teams, we redesigned the product to fit our capital and operating efficiency model, preserving the quality our customers valued. Within 1 quarter of the relaunch, Compaq India's market share moved from number 4 to number 1, with high profitability and better capital efficiency than Dell. We had outdelled Dell. We transformed impossible into possible. In 2000, I joined Citibank, but tracked Compaq and post-merger HP India's performance for many years, during which it remained number 1 in the market. Prior to producing this presentation, I checked again. HP remains number 1 to this day in India. Dell is number 2 in India. Asymmetric capital efficiency improves sustainability. The key takeaway is this: you don't have to be a CFO or finance person to make your business capital efficient. You just need to be curious and lead. In 2021, after working for Riyadh Bank in Saudi Arabia for a year, I flew back to my home base of Japan during COVID. As I spent more time in Japan, I reflected on how illogical it was that Japan had the lowest cost of capital and yet one of the lowest returns on capital. Out of curiosity, I started to research to understand why. Despite being a market minnow, I learned that Tesla was significantly more valuable than Toyota. Toyota had market power and economies of scale and was world-renowned for operating efficiency. But was it capital efficient? The Tokyo Stock Exchange didn't think so and warned Toyota. As an industry outsider, I started to apply the same modeling processes I had used at Compaq. I compared Compaq and Dell to Toyota and Tesla. The similarities are startling: cash conversion cycle, growth, cost of growth, EBIT margin, most importantly, return on invested capital. As Elon Musk recently told shareholders, efficient capital management is hard. As interest rates in Japan finally begin to rise, Toyota, as the world's most indebted company, will struggle to compete unless it becomes capital efficient. I began to model what Toyota could do to become capital efficient. I estimated Toyota could improve EBIT by USD 460 million, not by driving an additional USD 5 billion in revenue, hiring 13,000 employees, ramping up factories, increasing distribution, and lifting sales targets, but by applying management discipline to become capital efficient. We ran scenarios to analyze if you could collaborate equitably with your supply chain partners to improve both companies' EBIT by optimizing capital across supply chain balance sheets. We looked at vanilla weaponization of capital by just mimicking Tesla, assuming common suppliers. Toyota would improve EBIT by USD 2 billion, while Tesla would have 2 billion at risk. To explain it in layperson terms, imagine you're a company and sell $100 of products, but you don't get paid for a year, and the interest rate is 10%. It would cost you $10 in funding while you are waiting for payment. You would net $90. Even if you discounted 10% to get paid on day one, you could use that money to pay down debt and net $99. Velocity matters. Employees are subject to similar dynamics. Assuming a year for illustrative purposes, pay acceleration for employees has an equivalent impact. If an employee were paid daily, not only would the employee save credit costs, but equally deleverage debt. If the employee paid their mortgage in Japan daily versus monthly, they would pay a 35-year mortgage off 5 years earlier. That's the power of capital efficiency. It's really about working smarter, not harder. If Japan transitioned from a monthly cycle economy to a real-time economy, we calculate that employee effective income would improve by 10% and effective GDP by 20%. Increasing the velocity increases economic metabolism, partially offsetting the slowing economic metabolism of an aging population on the economy. While the initial market responses were no. Hopefully, you now know. This leads me back to another important career learning. Every transformation starts with no. No is the answer when someone doesn't know. No empowers people to take action. Now advances us towards our objectives. If we seek to drive change, we need to enhance learning. Learning enables us to transform no into now. shared language, learning, and experiences. Creates culture. If you want a culture of innovation and transformation, empower people through learning to transform no into now. The question to answer is, how can you transform capital efficiency in your division, company, or country? Start with being curious. Every leader think.
I wish you every success in taking those brave initial steps to making your company or country more capital efficient and competitive. Thank you.